Thanks very much. Hello, everyone. My name is Gerald Pasquarelli, and I'll be moderating the panel. I've been at Cowen for 5 years now, started covering beverages, and have been involved in the cannabis space since September of 2016. Happy to be joined on the stage by my fellow panelists. I think it makes the most sense to probably just go down the line and have each of you introduce yourselves and specifically talk about how long you've been involved in the cannabis space.
Sure. Thanks, Gerald. So I'm John Zamparo. I'm from CIBC Capital Markets. I've been there 5 years. We really just started looking at the cannabis space just over a year ago. So my background is I'm a chartered professional accountant by trade, but my background following that is at a large quick service restaurant company. So my perspective on the industry is informed by the retail and consumer side. So that's what we like to consider we bring to the table. And we now cover five names in the space. And I like to tell people it's never a dull moment in this industry. So it's very exciting for sure.
Hi, my name's Anna Sarin. I'm Director of Listings Development with the Canadian Securities Exchange. I was a broker for 10 years and then moved into working with junior public companies. I managed a bunch of M&A activity in the resource sector specifically, and then when the cannabis space came out, started focusing on that. I've now been with the CSC for 3 years, and it's been definitely an interesting 3 years. If you know anything about us, we have the most cannabis-focused companies of any exchange in the world.
Hi, good morning. Graham Kreinler with A Capital. I'm also a chartered accountant by training. I think we have 3 on the panel this morning, so should make for some fireworks here. A Capital has been involved in the cannabis space, I guess, since inception with respect to the public markets, and we cover 21 names right now of publicly traded equities across Canadian operators as well as operators in the United States.
Good morning, everyone. My name is Matt Bottleman with Canaccord Genuity. We've also been covering the space pretty much since the early days, which is funny. It's only about 4 or 5 years ago, but it seems like 20. I've been focused a lot on the Canadian licensed producers out of the gate, going back to about 2016. These are the names I know a lot of you are familiar with that are on large U.S. exchanges. More recently, I've been focused more on these MSOs or multi-state operators, and it's a fun experience. It's also more challenging because, as many of you are aware, there's a lot more regulations to get your head around. It's more of a state-by-state exercise as opposed to just learning sort of one federal oversight or one federal rule book. So that's what I've been spending sort of the last 12 months doing. We have about 4 analysts in our group right now that I head. And we're sort of from San Francisco to Calgary to Toronto, and as John said, never a dull moment, and it always seems like we're several weeks behind of what's been going on with the news flow, just playing catch up, drinking from a fire hose, so a lot of fun.
That's great. And Matt, Graham, John, as 3 equity analysts on the panel, I was hoping to get your thoughts on which companies in particular you're most bullish about. It doesn't have, just broadly speaking. And then as well, given kind of more, in my opinion, more of a focus on the U.S. MSOs today than maybe a year ago or 2, the investor sentiment that you're seeing with regards to both the Canadian LPs and the U.S. multi-state operators, and maybe how that's changed. So why don't we start with you, Matt?
Yeah, so it's a very dynamic process. A lot of the large Canadian licensed producers, as I mentioned, these are the companies that are on the NYSE or NASDAQ that potentially can get a long-only institutional investor involved, but it's probably a minority of the phone calls I get right now from institutions. Everyone's trying to line up the multi-state operator opportunity. I, for one, am very bullish on that space or on that opportunity set, mainly because you don't have the $20 billion valued companies yet. You probably have nearer term visibility on potentially what the fundamentals might be. The flip side of that is with it being a Schedule I drug in the U.S., there's a lot of accounts that are still trying to wrap their head around that and try to understand how much of a risk that actually is. And there's a lot of regulatory considerations that we have to track for it. But I think on a valuation proposition, the multi-state operators are certainly more attractive. And again, it's something I've focused a majority of my time in the last year.
Yeah, just to add on to Matt's point there, I mean, there's definitely an inherent valuation gap that we see right now between the Canadian operators as well as the U.S. operators. But I think we're at an interesting point with respect to the Canadian companies being in a point in the market with legalization, getting more data that we can analyze. There's certainly a focus on execution, But for some of the larger Canadian LPs, there's still a lot of opportunities, whether it's internationally, whether it's in the CBD market, and their size, their access to capital, and their cost of capital lets them continue to be leaders on these frontiers, offsetting that with what the execution is going to look like near term. And then with respect to the U.S. market, we think that it's not a perfect comp comparison between how Canada has evolved and how we think the U.S. has evolved. But at the same time, larger players of scale with good access to capital, lower cost of capital, we think that's going to be very beneficial moving forward as the U.S. is in a quote-unquote land grab phase at this point in time.
Yeah, I would echo what Matt said early on. It's interesting in this industry. It's very similar to other Canadian industries on the research side, where you don't formally cover American businesses necessarily, but you get an increasing amount of questions from clients on U.S. businesses, and that's not unlike aerospace, industrials, telecoms, et cetera, et cetera. So at CIBC, we only formally cover 5 what I would call traditional producers, as well as a retailer in the cannabis space. But more and more questions from clients nowadays are on the American names, and in particular the MSOs. I think it's a matter of becoming comfortable with management teams. For me, first and foremost, that's what I look at in this space. Valuation does matter, and eventually these names will have to trade on actual metrics, EBITDA or cash flow, whatever you want. But for now, I think there's a lot of promoters in this industry, and it's very important to get comfortable with management teams before you do any other form of analysis. So you'd ask for particular names that we feel compelled on, Gerald. For me, it's Canopy Rivers. I think it's gained the benefit of the kind of the halo of the Canopy Growth family, which you can consider top-notch management. It's I'd say a strategy that tends to lead the way in the industry, but at far more reasonable valuations. So at least for those who are traditional investors and do care about traditional valuation metrics, they can gain comfort that way. But I think we've just seen the start of the flow of capital move from Canada to the U.S., and I think that will continue just as we see more news flow on the regulatory side. Pick whichever act you want. I think that's more the driver in this space rather than anything fundamental in Canada at this point.
Very good. So speaking of U.S. MSOs, let's talk about the deal that was announced last Thursday between Canopy Growth and Acreage Holdings. Just as a brief reminder, Canopy took out essentially a $300 million call option to acquire all the outstanding shares of Acreage Holding in the event that there's a change in U.S. Federal legalization. And so, Anna, can you talk about it? Just walk us through how this deal materialized, working on the Canadian Securities Exchange, and just give us your high-level thoughts on the deal.
Sure. So this is a deal we haven't seen yet at this stage, and there's very specific reasons why it happened. Essentially, there was a point in time where the CSE took on applicants to Canadian licenses. The TSX took on the stance that you could only list with them if you had your license. This brought a flood of capital and companies to our exchange. And then the next step that happened for us was that we allowed for U.S. assets to list with us. As this market has developed and the Canadian producers have had a few reporting periods, we've started to realize that they're not generating the revenue that meets the valuations. So the flood to the U.S. companies that have great revenue, great management teams, have been around for a few years, have a proven track record. What this has done is we have these massive companies in Canada that are bound by Canadian assets only. And they've put a lot of pressure on the other exchange to change this point of view, but the other exchange got a legal letter of opinion that said there was just too much risk for them to get involved. They own a lot of assets in the U.S. and their CEO is U.S. based. So they tied their hands a little bit, unfortunately. So Canopy now sat there with a huge amount in their treasury, not a lot going on the Canadian side, and a huge valuation that they had to warrant to their shareholders. Their only option was to go to the U.S. And so what they've done is they've created this deal with Acreage, which is on the CSE, where they have the right to purchase Acreage Holdings if it goes federally legalized. And the term of this deal is only 7 years. So the shareholders are taking a chance that this deal will go through should legalization happen in 7 years. I think what everyone's wondering is, are we going to start seeing more of this? Because now these big conglomerates in Canada, they really want access to the US holdings. Are we going to see more deals? I don't know if this is necessarily a good thing. It is very speculative. I don't know if it's better for Canopy or for acreage, but Canopy shares did go up shortly after, I think around 10%, and acreage holdings went down about 5%. So the market is, they're fairly confused about what's going on, and it'll be interesting as we see more of these come to the table.
Very good. Graham, why acreage? If your canopy growth, in your opinion, what value add do they provide that other U.S. multi-state operators do not? Is it their geographic presence? Is it their very robust board of directors? Maybe both. I'd like to get your thoughts on that.
Yeah, so I think first and foremost, looking at a deal like this, I think the importance of it is, with Canopy looking to enter into the U.S., let's not forget that they had a number of assets that already gave them U.S. exposure in one form or another. So whether that's an option for a cultivation facility, a long-dated exchangeable option or warrants into a company like TerraSend or a company like Slang, Canopy had been busy building up their U.S. exposure for quite some time. But the deal of this size at $3.4 billion when it was announced with acreage, I think speaks to validating this multi-state operator or MSO model in terms of aggregating licenses and ultimately trying to get access to a U.S. consumer. So with that being said, I think it's safe to assume that Canopy was probably looking at entering the U.S. market via an MSO with a number of different parties, but with respect to acreage specifically, I mean, on a pure footprint basis, you get a company that is in the most states with respect to the number of licenses that they hold in 20, and their peers can range anywhere from, low teens to high teens. I think, if you were to ask Canopy, they would talk about oversight as well. Because of the structure of the deal, these companies need to operate as separate companies until that right can eventually be exercised if the opportunity presents itself. So having the management team and the board of directors that we see with acreage, I think, a company looking to do a similar deal like this really needs to, as John was talking about before, have a lot of confidence that management and the board is going to have proper oversight of a company, because a Canadian company doing this can't start overstepping their bounds and actually start operating their business to remain on side with the structure. So I think there are a number of factors that go in, and I think at the end of the day, if you're looking again at a land grab situation, having the most number of states where you're licensed to operate in is certainly an attractive feature.
Very good. And Matt, in your opinion, do you think there'll be more of these types of announcements, maybe short to medium term?
Yeah, it's hard to handicap if that could occur. I think that certainly every Canadian producer, licensed producer, if we're allowed, whether it be because of exchanges or federal law, would love to be in the U.S. market right now. I would echo the previous comments that you have 35 million, Canadians that might, produce a $10 billion market many years down the road. The Canadian regulations are not that favorable when it comes to the economics. You have a lot of wholesale margin going to the provinces. You have a price compression that's likely going to happen. A lot of provincial oversight in Canada over the retail side of things. So it's going to be very hard to squeeze those economics out of the Canadian market. Yes, there's a lot of optionality in Europe. We saw some German licenses being tendered, and in Australia and Latin America is at a very low base that looks to be ramping up. But those countries, in my mind, and the international opportunity isn't going to get you there. So I think there's a lot of potential relationships that could be cultivated, for no pun intended, for within the space for Canadian licensed producers that already have relationships. There's a lot of people that finance both U.S. companies and Canadian companies on the private side, and I think that you can glean where some of those relationships might be. So I don't know if anything's going to happen in the next 3 to 6 months, but I think that if the floodgates open, or if it becomes a little more easy to enter into these types of transactions without having to get into convoluted options and warrants and all of these things that are necessary right now, I think you'd see almost every single large cap Canadian LP enter the U.S. space. And I think you might start seeing it first and foremost on the hemp side, because that's a little more palpable when it comes to the regulations. So oddly enough, Canopy is the one large Canadian producer that already has boots on the ground, or soon to be boots on the ground, in the New York industrial hemp market. So I think you might see some of those types of transactions first. But I would guess that in the next, call it a year plus, you'll see more Canadian transactions in the U.S.
Gotcha. Anna, I think this is a good segue to kind of double back into what it is you do at the Canadian Securities Exchange. You know, being there and being so involved with the momentum that you've seen on a go-forward basis. Can you just speak to, you know, in your experience, how the industry has materialized from its infancy to where we are now?
Sure, it's been a roller coaster, that's for sure. As you mentioned, the industry, I mean, the industry has been around for a very long time. In the capital markets, it's been around for 5 years at most. And every single month, it's a completely new change, whether it's regulatory, whether it's a new company that's come to market, innovations that are occurring, where the capital is flowing to, which country is coming to the table. So we're all trying to keep up with what's happening. I think probably the most important element, and maybe these gentlemen can speak to this as well if they agree or not, I think the biggest shift was that the cannabis sector brought the next generation to the retail markets. It was something, especially in the junior space, that we were desperate for. It was an aging investor. And it's a really interesting time to invest because it's the first time in history that you can trade for $9.95 in your discount brokerage account. You have access on your phone to press releases as they come out, to stock prices as they change. So it's a very interesting time and an exciting time to be in the markets. You know, when I started not even that long ago, probably in 2002, you know, you're still paying $500 every time you did a trade and would have to call your broker to get the quote. So I think the next generation was incredibly important to come in. They understand the product, they like the product, it was sexy to them. And I think what's gonna start happening is they've all now come in, they've made money, not necessarily know why they've made money, and they've lost a little bit as well. And they're wondering where to flow the next capital. So as we age with this sector, we're also aging with this new investor. They've been at the table for a few years now, and they're becoming more sophisticated, and the markets are becoming more sophisticated. And I think that's one of the big shifts into the US sector is it's more sophisticated companies that are coming to the table. I don't know if you gentlemen agree with me or not.
Yeah, I would say, you know, in general, in terms of where the risk capital has been in the market, it's obviously been very, very receptive to the cannabis sector. And, you know, there's other macro factors that are going to affect in terms of which sectors people want to get increasing exposure to. But I think you're right in terms of cannabis being a very interesting example where, you know, the retail investor was first in terms of taking the risk capital and getting attuned to the sector, and then, you know, institutions coming in after the fact. And it's tough to think of another example of an industry where that has happened. And, you know, I think there's a lot of positive things for that. There's a lot of frustrations that can come with that as well in terms of, you know, the way the markets behave. But it's certainly an opportunity where you've had you know, intergenerational wealth that's been created in a very, very short period of time by, you know, a very unlikely confluence of events there. So, you know, I think there's a lot of things you speak to with respect to the way information travels and, you know, with the way that different types of investors perceive different risks and opportunities. They're held to different standards, whether, you know, you're being measured on your performance or you're trying to just make money for yourself, that have all come together and have really helped to grow, seed, and expand the industry beyond, I think, what a lot of people's expectations would have been, you know, even a couple of years ago.
I think something you said was very interesting, Anna. It's the parallels of the cannabis industry to the junior miners in Canada, and I think that's something that has to shift over time. There's so much background in Canada when it comes to commodities. Pick your favorite, you know, copper, gold, et cetera, et cetera. So many investors, whether it's retail or institutional, still look at this sector as a resource-based concept where you've got a large amount of some commodity. What can we extract it for? Who can we sell it to? Can we find another large mine of that commodity? And we don't talk about alcohol or tobacco or pharmaceuticals in this vein. We just don't. And I think the conversation has to pivot from this resource-based mindset that so many of us have in the Canadian investment community to a more differentiated product that has so many more nuances and is just not such a commodity. So we've started to see that shift, but I still see that among many investors I talk to, even sophisticated ones who talk about lowest cost producer. And it's a conversation I don't think is all that relevant 2 years from now, but we do see that that background of Canadian investors and how they've typically approached the sector.
That's a really interesting point, and something that we've argued is, some of the pushback we hear is that there's going to be ultimate price deflation, right? And the cultivation aspect and the extraction is going to become commoditized. But I would argue that cannabis is a consumer packaged good, similar to alcohol, similar to tobacco, where brands will ultimately develop, and that will dictate premium pricing, just like we see in tobacco, and just like we see in alcohol. Like if you look at Blanton's or if you look at a Knob Creek that sell for a huge premium, the raw materials that they're putting in might be a little more expensive than something that sells sub-premium, but they're not 7 to 10 times more expensive that they would sell on the shelf. So I think your point is well taken, that the conversation does need to shift, and I think it will over time.
The way we look at it too is it's sort of a necessary evil when it comes to when you look at someone's funded capacity or their lowest cost production, if they are a lower cost producer. It's something that we consider, at least in our research, as a cost of admission. Because if you look at any of the large Canadian LPs, let's say by market share, and those are a lot of the large cap ones, Canopy with 35% or some others that are in the teens or 20%, the only reason they're able to get that market share is because they raised capital early enough where they could build out those facilities, have enough capacity to actually be able to supply a very large purchase order to the various provinces. And if they weren't speaking in those terms a year ago or 2 years ago about how large their actual cultivation footprint would be, they probably wouldn't have the market capitalization to be able to raise additional funds in order to get there. But I would absolutely agree, and I haven't really met anyone in the industry, buy side, sell side, or other, that doesn't think this eventually isn't going to go to a consumer packaged goods sector where Bruce Linton will end up buying his raw material input or pharmaceutical ingredient from whoever that lowest cost producer is, once wholesale markets start to normalize and probably see a lot of pressure.
For sure. Let's get into what each of the equity analysts looks at in terms of valuing these companies. John, I know you said it's hard at this point because they're not really trading on fundamentals. There's always the potential for M&A and consolidation, which is going to warrant a premium. But how do you think about valuation when you're benchmarking against these companies that you cover?
Sure. So it is a bit of a challenge for the traditional investor who likes looking at free cash flow yield, unless you want to walk 3 years into the future. There are metrics you can use. We typically look at EV to sales. Nothing on a trailing basis, of course. I find it kind of comical when some investors say on a trailing basis you're trading at X. This product wasn't legal 7 months ago, so it's just an irrelevant conversation. And there is some hesitancy to look to calendar 2021 or 2022, but that's what you have to do in this industry. And in any nascent industry, you can't look at today's numbers. You really have to have some conviction about how the market will play out and make some assumptions. But there are other methods we've used, and I think this is how a lot of sophisticated investors are looking at the space, is to say, let's take other industries that we expect to be disrupted, whether it's alcohol, energy drinks, mood therapy, pain treatment, et cetera, et cetera. You can run down the list, and they're anywhere between 40 billion and 200 billion as an industry. And if you can disrupt 10%, and if you can get a 5% share of that, and if you can operate at a 20% EBITDA margin, what does that all add up to? And granted, that is incredibly dependent on your assumptions, and a tiny tweak can change your valuation from that company's worth 10 billion to that company's worth 20 billion. But I think that's true in any form of analysis. This is just far more dependent on the inputs you use. But I think that's the approach you have to take. It's certainly the strategy that some names like Canopy Growth have to go after the sleep aid market and other adjacent markets. So that's one way we look at it to gain comfort. But on a relative basis, it's purely looking at the top line, I think, on an EV to sales basis. And that does bother some people, not looking at profitability. But I think if you're too focused on profitability in first quarter of 19 or second quarter of 19, I think you're missing the bigger picture about what these companies are trying to become. And Bruce Linton has said this before. We didn't get $5 billion from Constellation to sit on it. We want to go invest. We want to go build our brand and build our network. So to look at any one particular quarter and see negative EBITDA, I think is a bit short-sighted. And you do have to have that willingness to look a few years into the future.
Yeah, I would agree with John, and I would say there definitely is an appetite for profitability and looking at EV/EBITDA from the institutional clients that we talk to. But I think the interesting concept is valuation and how it's an evolving conversation and how it's a moving target. And I think, in times when things are good in the market, it's certainly a question of relative valuation and how company A stacks up against company B, how that stacks up against the peer group. And I think if you're to look back sort of, mid to late November into December, the conversations change much more on an absolute basis. And, looking at companies in terms of what are they trading on cash, or, what does this market cap look like for what they're going to do over the next 12 months, not in the next 24 or 36, so on and so forth. So there's no set rule of thumb yet. We're still developing what the best time horizon is, what the best metric is, and how that gets changed over time with the various M&A deals and regulatory events that occur. But that lens between relative and absolute, most of the time I say we look at things on a relative basis, but it can shift on you pretty quickly, depending on what the situation in the market looks like.
Yeah, I would agree with all that. We take a much simpler approach in our valuations. We do a simple 2,365 times revenue and call it a day there. So it's a challenge. I would say the best way to look at it, I mean, when you're speaking about how to trade these stocks or who's a buy versus a hold versus sell, relative valuation, you can pick your metric because, especially the Canadian licensed producers, they're all subject to similar pricings, same regulations, similar demographics to where they're selling. So there's some consistency there. But I sort of use overall goalposts or sanity checks. So I say, okay, if you're looking at a multi-state operator, you clearly have to do it state by state and build that up in sort of a sum of the parts. So I'll look at a market like Florida, and the first analysis I'll do is I'll say, well, how large can this market be? And obviously there's a lot of that's population driven. What's allowed to be prescribed if it's only a medical market. What we think the usage rate will be in recreational markets where we have proxies like in Colorado, California, et cetera. And we get an overall market size, and from there it's more top-down approach where we say, well, what could a market leader potentially get in terms of a market share? And from there you get your revenues. You can, there's a lot of assumptions, as John mentioned, where you change one and there's a material difference, but you can get an overall goalpost of what the market should be. And if you go into the future, at least anecdotally or hypothetically, 5-10 years down the road, these names should trade at some sort of reasonable multiple, whether it's a consumer's multiple at 12 times, a pharma multiple at 25 or 30, somewhere in the middle. You kind of pick a normalized multiple and you say, 5 years, 10 years down the road, here's what a leader in the space might have in EBITDA, and here's what they would be valued if this was sort of a more normalized environment. And then you just have to take a hatchet to that for present value, for risk, for all unknowns, and bring it back to today. And it's a very complex, it's simple math, but it's a very complex analysis in that if you're looking at a multi-state operator, you're really doing that for 12, or in Acreage's case, 20 different states. Any one of them can have a material change depending on how they carve out that market. So after you bring everything back into present value terms, that's when I really like to look at relative valuation and say, okay, well, does it make sense that I value company A at an implied multiple, because we don't really slap any, joking aside, any sort of one multiple to any one company, but there's implied multiples that come out of your valuation conclusion, and from there you line it up and you say, does it make sense that, MSO X should be a 2X premium to their peer group? And if it doesn't, then there might be something in your assumptions that are off. But in terms of finding what a quote-unquote fair value is and what these names should be trading at today, I don't think there's really a right answer to it because of how dynamic and fast-changing the space is.
Can I just jump in one comment? I'm not allowed to give advice. My bosses would get very mad at me, but I do have opinions. The one thing I think we need to remember, especially in this sector, but in the markets in general, it is a secondary market. So it's not how many vapes are sold in the store. There's so many pieces of information that these guys spend looking at every day, and that information is changing, I'm sure, on an hourly basis. But it's all little pieces of information that go into it. And I think the one thing, as we're trying to figure out these valuations, is that the investment community just really likes it. And so there's more people buying, so the price goes up. And again, we have to look at some of the fundamentals, and as the investor gets more sophisticated with the growth of this sector, we also just have to remember this is completely secondary to the company itself. All the information that we can gather from the company might make a choice over another, but at the end of the day, you also have to factor in just investor sentiment.
For sure. For sure. And when you look at these multiples, the one thing that's fairly consistent is that the Canadian LPs are trading at a notable premium relative to the US MSOs. And so, although when you look at the absolute revenues, there are, in some instances, US MSOs that are deriving quarterly revenues approaching even some of the largest Canadian LPs. So what happened, in your opinion, Graham, that gets these multiples to converge? Is it solely based on regulatory catalysts within the U.S. at this point?
Yeah, I think there's a number of factors that play into it. I think that's probably one of the largest factors right now in terms of when you want to look at the spread between the multiples there. Cannabis being federally legal in Canada, being federally illegal in the United States. I mean, that's obviously what presents such a large opportunity for these MSOs, but I think that's what also puts a bit of a handicap on the valuation there. I think you can also look at something like simply, Canopy being traded on 2 exchanges, TSX in Canada, New York Stock Exchange in the US. The amount of liquidity, I think, looking last week after the Canopy acreage deal, the 30-day average volume of Canopy was about 2.5 million shares on the TSX, about 5.5 million on the New York, where acreage was trading about 250,000 shares, 30-day average on the CSE. So that's something where the Canadian operators have been in the market for a longer period of time. I think there's a better understanding of what that business model looks like. And I think the U.S. opportunity, although my colleagues here on stage probably feel like we've been doing it for a lifetime, it's still a relatively newer opportunity in the market. It's much more complex in terms of having to break things down state by state, get an appreciation of the regulatory and business environments at the federal level, at the state level, and then trying to sift your way through all the investment opportunities. I think there's the amount of sophistication and appreciation and understanding of the business models also has to develop as well.
I assume you would broadly agree, John?
Yeah, I think Graham's spot on. I think it's the regulatory side and liquidity are the 2 main issues. And the one point I'd add on the regulatory side is it's more about sentiment rather than specific actions. I mean, the market is forward-looking. It's not like everyone is going to sit on the current valuations of U.S. MSOs until the president signs a States Act that has already gone through other chambers. I mean, once you start hearing rumors of this, or key politicians who are on board and who become co-sponsors of whatever bill you want, I think that's the key driver for me. It's rather than the actual event. I think we've seen that time and again. The Farm Bill is one of the more famous ones. I remember looking at my board that day, and I think it was Charlotte's Web who was down on the day of the Farm Bill being signed, and that seems like the most obvious name that everyone would be on board with. It's a company that specifically focuses on CBD products, but I think that's built into expectations well before the actual event. But for me, it is regulatory first and foremost that causes multiples to converge. I think the one element that Canadians don't want to talk about is if that convergence requires Canadian multiples to decline rather than just U.S. multiples to increase. And there's different puts and takes there. I would say the ongoing data from Health Canada and StatsCan does spook some people. My advice to them is to look to advanced U.S. markets that are now 4 or 5 years into legalization, and there's different components, Canada-U.S., whether it's taxation or branding, and there's others. But I think we can't pay too much attention to any one given month, but there is the possibility that investors look at a Canadian market unfolding perhaps not the way they wanted to, and that's the way you see the convergence of multiples is by Canadians declining. It's certainly possible.
Very good.